Welcome back to Market Pulse. Today we're joined by Joe Winkley, Head of Corporate Services at Winterflood Securities, now part of the Marex Group. Following the recent acquisition, it's a timely moment to look at how equity markets are evolving, particularly when it comes to retail participation, capital raising, and the role of technology in connecting investors with opportunities. As always, our discussions are market focused and not intended to comment on politics. Joe, how have you seen UK retail investor participation evolve in recent years, and what's driving that shift?
First of all, I'd just like to say thank you very much for having me on here today. So I think the first thing to say when it comes to UK retail investment is actually to really understand where we are, particularly relative to the other G7 countries. And the story at the moment is that actually we are quite significantly underinvested as a nation. So to give you some stats, analysis done by Aberdeen last year indicated that the average retail investor has about 8% of their assets exposed to investments in the broadest sense, which would be kind of equities and funds.
Hmm.
When you look to the country that has the largest exposure, it's the US, where that number is
Hmm.
over 30%. So the starting point is that there is a lot to be done in terms of wider retail engagement, particularly with equity markets.
Hmm.
And so why is that? And I think there are three factors that have been in play over the last few years. The first factor is a regulatory factor.
Hmm.
The second is actually sort of corporates themselves and corporate behavior. And then
Hmm.
the third, which we can come on to talk about in a bit more detail, is actually the retail investors themselves and the drivers behind retail investment.
Hmm.
So just kind of picking up on the first two, I think that the first thing to say is that from a regulatory perspective, um, it's not as if the regulators ever really wanted to stop retail investment. I think the key thing from their perspective was they wanted to actually protect the retail investor and protect
Hmm.
customers. The challenge was that in doing that, what they did is created friction. So they made it harder for companies to market to retail investors, to involve retail investors in capital markets transactions.
Hmm.
And the reality is that from a corporate perspective, you are going to take the path of least resistance. If there is friction to involve retail, the answer is often to not involve retail.
Hmm.
That is something which has been at the forefront of recent regulatory changes. And over the last few years, we've seen a number of these regulatory frictions being removed and taken away. So, in terms of that first point, it's key to note, I think, that as of the 16th of January, a whole load of these regulatory changes have been taken away or unwound. And that means that it is so much easier now for corporates to involve retail investors if they do capital markets transactions. So,
Hmm.
so that's a really big win in that regard. The second reason is corporate behavior.
Hmm.
And this is something which, again, has taken time to change. If you go back maybe 10 years, it was very, very common for corporates, if they were doing a capital raising, to only focus on their institutional investors.
Hmm.
They would not include retail investors. That has changed over time. And why has that changed? It's changed partly down to campaigns by the likes of the Investment Association on behalf of their underlying shareholders. It has changed partly as a result of corporate governance and the idea that actually including all of your shareholders in a capital raise is the right thing to do. I think intuitively we would all see that being the right thing. But I think that is now more entrenched in corporate behavior and corporate governance. And then the final part of that is actually where we come into it, which is actually just making the process easier for companies to interface with their retail investors. So I think when
Hmm.
you put all of those together, we're in a much, much better place today than we were a few years ago. Um, but it doesn't mean there still isn't a lot more work to be done.
Yeah, definitely. And why is it becoming increasingly important for issuers to include retail investors as part of their capital raising strategy?
So there's a number of different ways of thinking about it, and I think the first thing to say is just focusing on the, kind of almost the pure economics of it, which is that retail investors in the UK, in terms of what is actually invested, you're probably talking about 2 trillion of assets.
Hmm.
So a lot of people think about retail and they think about sort of people having £100 here, a few £1,000s invested. what you're actually talking about is an enormous pot of capital that can be accessed. And so I think that's the first thing to say is that when you just look at it through the lens of raising as much capital as you can, having access to 2 trillion of assets is an enormous number. So I think that'd be the first point, which is that it makes sense. I think that the second point is a little bit more nuanced, which is looking more in terms of where capital is being allocated by institutions and pension funds. And what we are seeing and what we've seen over a period of time has been much more focus on large caps. So again, talking about the UK, but you might see similar themes ex UK as well, which is where large cap FTSE 100 stocks very well supported by institutions and pension funds. The further you go down into mid and small cap, actually there are fewer and fewer institutional investors that now invest in that space. So where do you have to look? Where you look is to the retail market. Retail investors, they like stories. They
Mhm.
like growth stocks. They like areas that where they can buy into something and see it grow. Um, and that's where there's a huge opportunity to drive more retail engagement at the smaller end of the market and the mid cap end. It doesn't mean they're not relevant. And if you are a Marks and Spencers or a Vodafone, you will have a huge number of customers. Why not facilitate them through your equity as well?
Mhm.
So I think there's an argument even in the big stocks that retail is important. But as you go down the cap spectrum, they become, I'd say, more and more relevant. And then the final point is one which is based around liquidity, which is that obviously, the reason for having a listing and to be a listed equity is to drive that secondary market liquidity. First thing to say is that actually retail investors are typically long term. So again, one of the things that we hear is, oh, well, retail, it's fast money, it's hot
Yeah.
money. It's not. It is typically very long term money. So you have got long term supportive shareholders, but the more you've got, the more secondary market trade there will be. So again, there is a correlation between the more retail you have on your register and the more secondary market liquidity you see. So I'd almost turn it around the other way. Your question is kind of why include retail? I'd turn it around and say, well, why wouldn't you?
Yeah.
There is limited downside other than what I mentioned earlier, which is almost the kind of hassle factor of it. But in terms of what it brings to the company and what it brings to the share register, there are a lot of positives to be had.
Mhm. And then wrap has become an important player in the corporate fundraising space. Can you explain what it is, the role it plays for issuers, intermediaries, and investors as well?
Yeah, absolutely. So RAP is an acronym. It's the Winterflood Retail Access
Hmm.
Platform. Um, and what is it? So the best way of conceptualizing it is that it is an electronic aggregation portal. What do I mean by that? It connects companies to retail intermediaries, and through those retail intermediaries, it connects to the end investor.
Hmm.
So at Winterflood, we connect to over 150 different retail intermediaries. What do I mean by retail intermediary? It is the likes of Hargreaves Lansdown, AJ Bell,
Yeah.
Interactive Investor, Charles Stanley. I mean, where you would have your ISA account, your SIP
Yeah.
account, your individual
Platforms.
investment, so
Yeah.
the platforms and the wider wealth managers as well. If you're a company and you are looking to connect to the retail market, it is a very fragmented market.
Yeah.
So people do not hold it only in one place. We act as that central aggregation point. So what you would do as a company is you would come to us and say, we're looking to do a capital raise. We would then go out to all of the underlying intermediaries. We'd make them aware of the transaction, and they then have an electronic portal they can effectively log into. They can upload their demand. We can then aggregate that, and then we can pass that through to the company as a single line. They can then decide how to allocate, and then we allocate and settle further down the line. So,
Mm-hmm.
in summary, we were crunching the numbers on this the other day. We think that RAP indirectly connects to about 14 million UK individuals.
Wow.
So that's the kind of what you're getting, and you are doing that through a single counterparty.
Yeah.
So what we're trying to do is make something that could be very complicated very easy for a
Hmm.
corporate. So that's what Wrap does.
And how does technology, AI, and data feed into wrap, particularly when it comes to improving access and participation in capital markets?
That's a really good question, and I think it's something where we've seen over the last few years technology becoming ever more important in the way that people interact with markets. So everyone will now have an app.
Yeah.
If you want to make an investment, you no longer have to ring up a broker. You can do everything electronically. You can
Hmm.
do it all through apps. Um, where are we in that? What we have been trying to do, and this is where RAP comes into it,
Mhm.
is provide an electronic solution for the end intermediaries, which then helps their end customers. I think it's fair to say we haven't created the ultimate sort of end game of all of this would be an
Mhm.
end-to-end solution where it's frictionless for intermediaries. But we've certainly helped to make that process smoother, both for the intermediaries and also for the companies themselves.
Mhm.
So we are providing a technology solution, but I think there's a lot more that can be done. But one of the things, and you mentioned data and AI, one of the things we are really focused on at this moment in time is using the data we have at Winterflood, using the proprietary retail trading data that we have, and using AI tools to help companies. And what do I mean by that? Where we are really trying to help is by analyzing retail trading flows. We've got huge amounts of data around retail trading flows, using those retail trading flows, using AI models, using historic transactions that we've done. So we've done over 120 wrap transactions now. We've got a big and growing data set there.
Mhm.
And where would we like to get to? Where we'd like to get to is for almost any listed company in the UK to be able to come to us and say, we're looking to do a capital raise. Can you give us a very accurate model, estimate, analysis of what demand we're going to see from retail?
Mhm.
And when you look at all the factors in play, the number of shareholders on the register, the recent trading, whether we're seeing net buying, whether we're seeing net selling, what similar companies have done where we've done wrap offers for them historically, if you
Mhm.
plugged all of that into a big model, chances are you're going to get more and more accurate data coming out. We are
Mhm.
already working on that process. I'm lucky I've got a team of data scientists at Winterflood who are plugged into all of this, and we are in the process of developing these kind of underlying models. And that's where it really gets exciting. And I think over the next few years, technology, it's only going to become more important. But I think it's about how you use the technology and how you use the data. And to the extent we can make the information we have more relevant and more helpful to companies, the better it is for us.
Mhm. And how can clients get access to this? Do you do like a report?
Yeah, so in terms of our retail analytics, what we are able to do, and again, this is through the analysis that we already do, we're able to provide companies with really detailed data on their own retail trading.
Okay.
And so, what you're able to look at is what is the retail sentiment
Mhm.
in your stock? What have retail investors been doing? Are they buying? Are they selling? And you can even drill down and look into very short time periods to say we put out our results on this date. What did we see in terms of investor engagement?
Mhm.
We took out an advertising campaign. We launched a new product, whatever it might be.
Mhm.
What you can do is actually drill down using the data that we have into the weeds and say, actually, this is what the investor response was, and that can then help you iterate your PR strategy or
Mhm.
your marketing strategy. So what we do is we create and we can do it for any listed equity. We create a report on that company. We can compare that company to its peers.
Mhm.
So it's not just looking at what your retail trading is,
Mhm.
but it's are you seeing more demand or less demand than your competitors, and
Mhm.
if so, why? So there's a whole load of information that we can provide. And as I said, you can get really granular in terms of saying we want to look at one particular investment platform. We did a big marketing campaign with AJ Bell, say.
Mhm.
Um, what has the result been of that? Have we generated more demand? We can help with that kind of analytics.
Great. And looking ahead, how do you see retail participation evolving in the next few years?
So I think this comes back to the very first question, which is that as a country, we're underinvested. And it's fair to say this has not gone unnoticed, both from a regulatory perspective, but also from a government perspective. And I think this is one thing to say where there has been very consistent sort of government initiatives to really try and drive more retail engagement with markets and more retail investment. So regulatory, we've seen huge steps forward. There have been a lot of changes that have made the market much more open to retail investors, making it a lot easier for corporates to raise capital and include retail. So the next step is how do we get people to then
Mhm.
invest? And I think this is where we're about to see, and this is why this timing of this podcast is actually quite good because in the next few weeks,
Mhm.
we're about to see effectively an industry sponsored awareness marketing campaign
Yeah.
where there are, I think, 19 different financial services companies working alongside the Treasury, and there will be national ads, there will be TV ads. And I think the overall aim is going to be to say to people, what you need to be thinking about is not just cash as a savings vehicle, but
Mhm.
also the power of investment, what you can generate over time.
Mhm.
And I don't think it's going to be focused on saying you need to take your money and put it into UK stocks. I think it's going to be much more around just getting people to think about,
Think
is
differently,
cash
yeah.
working as hard for you as it could
Mhm.
be? And if you were to invest it, what kind of outcome would you expect if you had a long term view?
Mhm.
There's also been a bit of a kind of political nudge, I would say, in the change to the ISA rules,
Yes.
where cash ISAs used to be 20,000, so you could hold your entire ISA in cash, and a number of
Mhm.
people do that. That has been reduced to 12,000. So if you now want to take up your full ISA allowance, you would have to invest 8,000 in
Mhm.
stocks and shares.
Stocks, yeah.
So that's a bit of a nudge factor. It'll be interesting to see how that plays out. I'll be honest with you, I'm not expecting overnight results. I don't
Yeah,
think
it's a
this is
long
something
term.
it's where it's going to be kind of transformational in the short term. But I do think the direction of travel is really important because we are underinvested. It is not a good thing for people to be holding cash over the
Yeah.
long term, particularly when we've seen a quite a high inflationary environment in the past. We may
Yes.
be heading to another one depending on what
Yeah.
happens. So there are merits in having long term investments, and that's not to say people should take all of their money and put it all into a
Yes. Yeah.
single stock, whatever it
Yeah.
might
Yeah.
be. But overall, I think if we can nudge more people into that investment side, and again, I was reading some numbers. So if we took the amount of money that is sitting in UK bank accounts in cash, and we just matched where the US is over
Yeah.
30% invested, that would be over 3 trillion of new assets going into the market. I mean, it's unlikely we're going to get there, but those are the kind of numbers we're talking about. And that comes back to your question about why include retail, because
Mhm.
it's huge.
Yeah.
And even if you can get a tiny fraction of that to move out of cash into investment,
Mhm.
that could be really quite impactful in terms of market dynamics and secondary market liquidity.
Mhm. Joe, you mentioned the industry campaign launching in the next few weeks. Why do you think UK investment is lower compared to the likes of the US?
I'm not sure it's something that we really know the answer to, but I can put a few sort of ideas out there and
Mhm.
certainly look at some comparators. And I think the first thing to think about is actually where is it that people are invested in the UK?
Mhm.
And again, if you look at the average UK investor, they will typically have about half of their assets invested in property. So that would be their own
Mhm.
home, effectively. The equivalent number, and again, I'll use the US as an example, is about 25%. So that means that almost from the starting point, we have got more of our assets tied up
Mhm.
in real estate property than the equivalent US. But I don't think that's the whole picture. I think there is something else that has been going on over the last few years, which has been very much a kind of cultural shift towards savings. We are a culture where people save. They
Mhm.
put the money in the bank. They feel that it's safe in the bank. It's something you can access. The challenge with putting money in the bank is that over time, obviously, it gets eroded by inflation, and
Yes.
so it may not be the best place to invest, but it is clearly somewhere which, as a country, we are compared to other countries, we are overinvested in cash. Your question is why is that? And I kind of look at the kind of the cultural side of it, but it's fair to say it hasn't always been this way. So again, if you go back in time and you look at equity participation in the 1960s, 70s, 80s, and even the 90s, there was far higher UK equity participation. I think a lot of it was particularly driven in the 80s, maybe into the 90s, was by the privatization where there were a number of large advertising campaigns. There was the Tell Sid campaign in the 1980s, which really drove a number of people who may not have owned equities before into the equity markets. I think all of that has now fizzled out.
Mhm.
So we're now in a situation where there hasn't been any real momentum behind investment. There hasn't been any really big stories. We haven't seen big UK IPOs coming through that are going to get people really excited.
Mhm.
When you look at the companies that people could get interested and excited, it's all US. We see UK retail investors buying Tesla. They'll
Mhm.
buy Nvidia. They'll buy Apple. They'll buy
Mhm.
Amazon. They'll buy the Mag 7. In terms of the UK markets, we haven't got anything that has captured investors' imagination in that way. So I think
Mhm.
I think that's a big part of it as well. So I think you've got a combination of factors. You've got House prices is just one issue that we have as a UK.
Hmm.
But putting that to one side, I think you have got a cultural barriers to overcome. I think there's a lot of financial education needs to take place. But ultimately, we have seen a dearth of IPOs. The capital markets have been quite subdued in the UK for the last few years.
Hmm.
And it may be that what we need is really sort of a turning in capital markets to then help drive investors to get enthusiastic about investment.
Great. Thanks, Joe. And thanks for everyone for tuning in. We look forward to you all listening to the next episode of Market Pulse.
Thanks, Venus. Thanks for having me on. It's been great fun. Thank you.